The stock market. A thrilling casino, a rigged game, maybe it's just a place where the future is traded. But like any good casino, it needs rules. Why? Because without rules, things get crazy. People panic. And when people panic in the market, everybody loses. That's where circuit breakers come in. They're like the referees of the market, stepping in when things get out of hand. They halt trading, giving everyone a chance to breathe, think, and avoid a complete meltdown. Circuit breakers are designed to prevent another Black Monday, a day when the market crashed so hard, it felt like the world was ending. Of course, the world didn't end, but a lot of people lost a lot of money. So, circuit breakers are a bit like airbags in your car. You hope you never need them, but you're damn glad they're there when you do. They're not perfect, these circuit breakers. But they represent an attempt to bring some order to the chaos. They're a reminder that even in the wild world of finance, sometimes you need to slam on the brakes. October 19, 1987, a day etched in market history, Black Monday. The day the Dow Jones Industrial Average plunged by 22.6%, the biggest single-day drop ever. It was a bloodbath. Panic selling swept across the globe like a virus. From New York to Tokyo, investors dumped stocks like they were radioactive. The cause? A perfect storm of factors program trading, overvaluation, and fear itself. The market was ripe for a fall, and fall it did. Black Monday exposed the fragility of the financial system. It showed how quickly a bull market could turn bearish. The crash wasn't just about numbers, it was about people. People who lost their savings, their homes, their dreams. In the aftermath of the crash, there was a collective realization. Something had to be done. The market needed safeguards, mechanisms to prevent another Black Monday. And so, circuit breakers were born. These market circuit breakers were a direct response to the chaos of 1987, a way to prevent history from repeating itself. So how do these circuit breakers actually work? Think of them as emergency brakes for the stock market. When the market free falls by a certain percentage, the breakers are triggered and trading comes to a screeching halt. This pause, typically lasting 15 minutes, gives everyone a chance to catch their breath. It prevents panic from feeding on itself, stopping the downward spiral before it becomes a full-blown crash. There are different levels of circuit breakers, each triggered by a larger drop in the market. The first level might be triggered by a 7% drop, the next at 13%, and the most extreme at 20%. The idea is to provide a graduated response, intervening only when absolutely necessary. These pauses allow investors to digest information, reassess their positions, and make more rational decisions. Circuit breakers don't prevent losses entirely, but they can limit the severity of a downturn. It's like a fire extinguisher for the market, designed to contain the blaze before it burns the whole house down. Circuit breakers are just one tool in the market's arsenal. They're not a magic bullet, and they don't mean investors can afford to be complacent. Understanding market signals is crucial. Keep an eye on economic indicators, company earnings, and geopolitical events. These factors can influence market sentiment and trigger volatility. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographies. This helps mitigate risk and protect your portfolio from sudden shocks. Most importantly, don't panic. Emotional decisions often lead to costly mistakes. Market fluctuations are normal. Have a long-term investment strategy and stick to it. Remember, circuit breakers are there to provide a safety net, a chance to regroup when the market gets rough. They are a reminder that even in the face of fear, a measured approach is always the best bet.